Hello, everyone. So now welcome to the new topic, that is the capital market instruments, which is one of the last topic of this third module. So let's see what are the things and this very important question. So coming to the concept, let's discuss what is the capital market all about. The capital market, as it is known, it is the segment of the financial market that deals with the effective channeling of medium to the long-term funds from the surplus to the deficit unit. The process of transfer of funds is done only through the instruments, which are documents or certificates showing the evidence of investments. Now, let us see basically there are four types of instruments. The first one is called derivatives. The second one is debt instruments. The third one is equities, and the fourth one is preference shares. So let's discuss about the debt instruments. Before that, let me say that there are basically 6 types of derivative instruments: forwards, futures, options, swaps, credit derivatives, and hedge funds. So let's discuss them in detail. So first thing is about the debt instruments. A debt instrument is used by either companies or governments to generate the funds for the capital intensive, that is for the heavy and basic, or that is a highly huge capital investment projects. It can be obtained either through the primary or the secondary market. The tenure of this category ranges from 3 to 25 years. Investment in such instruments is most at times risk-free and therefore yields lower returns when compared to the other instruments in the capital market. Now, when the instrument is issued by the federal government, it is called a sovereign bond. When it is issued by a state government, it is called state bond. When by a local government, it's called municipal bond. And when it's issued by a corporate body or a company, it's called debentures, or it is called industrial loan or corporate bond too. The second type is equities, which is also called common stock. This instrument is issued by companies only and can only be obtained either in the primary market and the secondary market. Investments in such types of securities translates the ownership of the business. As we can see, the contract stands in the perpetuity or in continuity unless sold to another investor in the secondary market. The investor therefore possesses certain rights and privileges, like to vote and hold the position and all in the company. The risk factor in this instrument is high and thus yields a higher return whenever successful. But we can't predict always it to be the same. Holders of such instruments, however, rank bottom on the scale of the preference in the event of liquidation of the company, as they consider the owners of the company. The third one is the preference shares. Such instruments are issued by corporate bodies and the investors rank second after bondholders on the scale of the preference when a company goes under. Such instruments possess the characteristics of equity in the sense that when the authorized share capital and paid up share capital are being calculated, they are added to the equity share capital to arrive at the total. Preference shares can be treated as a debt instrument as they do not confer any sorts of voting rights on holders and have a dividend payment which is structured like interest coupon payment, which is paid for the bonds. Preference shares may be irredeemable, convertible. That means in this case, upon the maturity of the instrument, to the principal sum being returned to the investor is converted to equities, even though the dividends or the interest had been earlier paid. The second is it may be irredeemable and non-convertible. Here, the holder can only sell its holding in the secondary market, as a contract will always be rolled over upon the maturity. The instrument will not be converted to equities. And third, we have redeemable. Here, the principal amount is repaid at the end of the specified period. In this case, it is treated strictly as a debt instrument. Then the fourth type is the derivatives. These are instruments that derive from other securities, which are referred to underlying assets. And underlying assets are those assets based on which the value is derived in the contract. Such a contract is called derivative contract. Now, here the price, riskiness, and the functions of the derivatives depends upon the underlying assets. Since whatever affects the underlying asset, it must affect the derivatives too. The derivative might be an asset, index, or any other situation too. Can be weather derivatives, credit derivatives, whatever it is. Derivatives are most commonly available in the developed countries. Now, there are basically we have 6 types of derivative instruments. The first is a forward contract. A forward contract is actually a custom based, or we can say it's a ready-made type, tailor-made type of contract, which is where the buyer agrees to purchase the underlying assets from the seller at a specific price on a specific date. And forward contracts, they can be issued at premium or a discount or whatever it is. And there's a price which is being fixed in the forward contract, which is called forward price. And forward contracts they are more customizable, meaning to say the customers can do according to their wish. So this sorts of freedom is being provided in the forward contract than the futures, because futures are standardized. And the limitations of forward contract has been corrected with the upcoming generation or the existence of futures contract. Now, futures contract means it is standardized forward contract where the buyers and sellers are brought together at an exchange. The buyer is obligated to purchase the underlying asset at the set price and date. The third is the options. Options, as the term states, it is an option, which means it is not an obligation, but it's a right to buy or sell. We basically, if you see the option contract, they have 2 types. So basically, we have call option and put option. Call option is the right to buy, and put option is the right to sell. So an option contract is actually a right which the buyer or the seller they get actually. And here the right is given to the buyer, but not the obligation to buy or sell something at a specific price on or before the specific date. With a forward contract, the buyer and the seller are obligated to make the transactions on the specified date. Whereas with the options, the buyer has the choice to execute their option and buy the assets at the specified price. The fourth one is a swaps. Swap means it's an agreement to exchange future cash flows. So we can find one cash flow is a variable and the other is a fixed one. So for example, if you say a bank is holding a mortgage on a house with a variable rate, a particular interest rate, which is variable, fluctuating in the market, but no longer wants to be exposed to the interest rate fluctuations. They could swap that mortgage with someone else's fixed rate mortgage. So actually we can find more of, moreover, there is a currency rate fluctuations, exchange rate fluctuations happening. So based on that exchange rate, only such simultaneous transactions are happening. Such contracts are called swaps. And here, the next one is the credit derivatives. It's a financial contract that allows the parties to minimize their exposure to credit risk. Credit risk is the risk which arises because of when you give loan or something, when you don't get it paid back. So when the credit worthiness of the debtor is very low, obviously the credit risk is borne by the creditor. Then credit derivatives consist of a privately held or negotiable bilateral contract traded OTC, over the counter, between the 2 parties in a creditor or debtor relationship. And the last type of derivatives is called hedge funds. They are a form of alternative investments that pools capital from the individual or the institutional investors to invest in various assets, which is offering a complex techniques and all that helps in the risk management. So these are the important helps for today. Thank you. Have a nice day. Bye.